Welcome to Turning Hard Times into Good Times. I'm your host, Jay Taylor. I'm speaking to you on the 20th of December, 2016. I'd like to remind you I'm also the author of a newsletter, Jay Taylor's Gold, Energy, and Tech Stocks. And my company, Taylor Hard Money Advisors, is in partnership with Chen Lin, who publishes What is Chen Buying, What is Chen Selling. And to sign up for either my letter or Chen's, you can go to miningstocks.com, or call our number here in New York at 718-457-1426. I want to thank each of you for listening to the show, making it one of the more popular shows on the Voice America Business Channel. Also encourage you to continue sending along your questions, comments, criticisms, and praises to questionsfortaylor@gmail.com. I want to thank our sponsors for making this show economically viable. Our sponsors for today's show are Orion Resources, or RN Resources is the correct pronunciation, and Novo Resources. Title of today's show is Trump Destined to Mirror the Hoover Depression. Dan Oliver, Michael Oliver, Gwen Preston, and Eric Coffin are the guests on today's show. Drawing from Roman history, Dan Oliver was one of the few financial analysts who predicted a Trump victory. But be careful what you wish for, Mr. Trump, because in many ways you are inheriting a mess similar to, but exponentially greater than that inherited by President Hoover. And there are also parallels to the presidency inherited by Richard Nixon, according to Dan Oliver. So the question is this: we want to ask Dan: Can Trump avoid the similar disastrous outcomes that President Hoover had, to a lesser degree, the difficulties that Mr. Nixon had? What will that mean for the equity markets, for the bond markets, for the precious metals markets? We make a note that it certainly during the 1930s, the gold markets, the gold share companies did extremely well. So sometimes under deflationary environments, gold mining companies can do very well. So we want to talk to Dan Oliver about some of those issues. And in just a few minutes after our first commercial break, Gwen Preston and Eric Coffin, two newsletter writers who cover the junior exploration sector, will join me to provide a brief outlook to find out how they're viewing the markets as we head into 2017. And also we'll ask them for a couple of their favorite junior exploration stock picks as well. But now we're very grateful once again to have Michael Oliver with us to give us his up-to-date views on the markets. Thanks for joining us, Michael.
And great to be here. And just to clarify for your listeners, Dan is no relation to me. He and I swap market letters, and but anyway.
Oh, you're good. I'm glad you do that. I'm glad you do.
The gold market is on everybody's mind, and especially your listeners, and I can understand. There's a lot of lessons to be learned here, aside from the historical ones you just mentioned, that might well play out. But I, as a technician, tend to overlook those factors. I can appreciate why, fundamentally, the Trump election, the Brexit vote, the pending election of a conservative in France, and all these type of changes that are happening have caused people to reassess fundamentals and say, well, all the errors of the past it's okay now because we've got good people coming to the fore to cut taxes or, whatever. And I agree. But I issued a report today, and this applies to the gold market because gold is behaving lockstep with T-bonds recently to the downside, lockstep with the euro to the downside, inverse directly to the stocks to the upside, and the dollar index to the upside. But when I measure them all, it's like measuring brothers and sisters. They're of the same body. They move inversely or coincidentally together. And I'm still of the opinion, and in particular regarding the T-bond market, which we became very bearish on several months ago, up in the 160s on the T-bond futures, and they're now in the 140s. But I think there is a very sharp rally to come in the T-bonds. I can see the same potential in gold and the same potential downside in the dollar, and therefore I assume, because of the linkages so strong, especially over the last several months, that the S&P will go down if the dollar goes down. Dollar index, just for example, and I think this is important to gold people because if these guys go, gold will go the other way. Dollar index is above 103 right now. It's been above it a couple times in the last 2 weeks. That has exceeded the price peaks of early this year and last year that were just above 100, around 100.50. talking the dollar index cash. So it's marginally gone over a 2-year period, 2% higher or 3% higher than it was about 2 years ago, which is hardly a roaring bull trend. But it did it, and it's up there beating its chest a few percentage points out above this box of prior price action. If the dollar index now above 103 slips back to about 101.50, I see an intermediate downtrend beginning, and the problem is that if it gets into next year and trades under 99, so we're talking about 3 or so 4% drop from current levels, it breaks an annual momentum trend, which would be the first time it's done that, which should set in motion a lot of other factors, including a reboost in gold. As far as gold goes itself, I had a number that we issued a few weeks ago that I said, okay, we originally said buy gold, but we emphasized gold miners back in February. That's when gold moved up from the thousands into the 1140, 1150, 1160 zone. That 1140 to 1160 zone was our buy zone. And we pounded the table, but we strongly suggested that probably gold miners would beat gold this time around, and they did. Using the GDX, it did vastly better than gold. In fact, though gold has now come back down to our original buy levels and slightly below that 1140 area. It's 1133 right now. The GDX, when it broke out, was at 15.5 to 16, based on our annual momentum trend structures. It surged to 31. It's down right now to 19. So it has not retraced all the way back to our original buy levels. However, what we don't want to see out of gold, and this will put us into neutral, not negative, is to trade the active nearby contract of February down to 1119.60 to put a precise number on it. If I see that, my hands go up. I say, uh-oh, it's a little too deep for me. I've gone neutral. I can't be bearish because there's certain other factors in play technically on gold that argue, no, this argument go down, take out the lows is highly unlikely. I know a lot of people are thinking that right now. Now, on the other hand, let's say we don't go down to 1119.60. We've probed into the 1120s twice, last week and this week. Right now we're in the mid-1130s. If you uptick gold this week, and these numbers drop each week, into the 1154 to 1160 zone, I think you're breaking out upside, enough to generate a strong rally. And if you can rally the gold market up to high 1100s, 1200 after such a breakout, which would probably be coincident with T-bonds having a rally, probably be inverse to the dollar having a sell-off, then I don't think gold's coming back to this low. I think you've seen the low. So right now we're about $20 short of an upside breakout and about $14, $15 above a number that I don't want to see. We're sort of stuck in the middle there.
All right, Michael, you talk about the T-bonds, a counter-trend rally for T-bonds if you're expecting that to happen. If gold rallies, is that a counter-trend rally?
The difference is that annual momentum gold broke out positively in February. Now, normally when you break out a very clear annual momentum structure, it's good for several years. Now, the T-bonds just freshly broke in October through supports on our annual momentum and 200-week momentum, which is like a 4-year average almost. Not breaking the average, but breaking structures on the charts. That indicates T-bonds have topped, yields are going up, but they're not just going up briefly, they're going up longer term. So a rally in the T-bonds is counter-trend to their longer term look. Right now, I still view the gold drop as counter to its uptrend. As serious as the drop is, it's counter to the momentum uptrend that was broken out in February. So, but not right now, forgetting the long term, I'm focused more on what you might call a trading time scale. The kind of thing that if you can break out, it's worth a surge of three or 4 weeks. But in the case of gold, because of certain things that happen next year, change in the 3-year average, for example. This year it was at 1244. Next year it drops to about 1180s. You ever see that number again, you're not going back down. And so all you need is just to get a spark of a rally. In the case of T-bonds, the rally will fail. In the case of gold, I don't think it will. So the current alignment that we see that is very disciplined, either inverse or coincident, between S&P and dollar one way, T-bonds, euro, and gold the other way, those linkages I don't think will persist longer term. But for the moment, they do exist. And I think they're probably important. And so if you're watching gold, I'm arguing you should be watching T-bonds, you should be watching the euro for sympathetic moves to the upside that indicate recovery. Euro, for example, is 103, 104 area, lowest level of the last 15 months, but only marginally below the lows of the last 15 months. It's been a very narrow 15 months, by the way, about a 10% range. If the euro trades up to 108, which is say a 4-cent rally, anytime next year, its annual momentum goes fully positive. It'll take out this year's momentum high that it achieved. Why? Because the 3-year average is changing, and therefore the momentum trend structure will change if the euro can merely pop 4 cents.
All right.
So a lot of big things can happen with a little rally, is what I'm saying.
All right. Well, that's very good. One more quick question. I need a quick answer, actually, because we're running out of time here. But listener Mark has written, and I think you've answered his questions on gold, but he's also noting that uranium stocks are looking pretty good, and he's wondering if this might not be part of the overall bullish commodity complex that you've been talking about. Do you see it that way still, Michael?
He's observant. Yes, I put out a uranium report a few weeks ago, in fact. I don't do it often, but probably twice a year. There is a thinly traded uranium futures contract. It looks like it is turning up on a what I would call a quarterly momentum basis. Its annual momentum is still negative, but it has the type of base that suggests if you can get the rally going, it won't take a lot to turn its annual momentum up. So yes, I agree. I think that the commodity complex upturn is a mixed, not unified process. In other words, we saw oil, natural gas, sugar, gold and silver have big up moves this year. And there's some down moves too, but net on balance up. But the grains and the meats laid low. I think it's their turn next year to come to the forefront of the commodity complex, in which case you'll have all the commodities will be in some positive or moderately positive trend. And at that point, the Bloomberg Commodity Index, for example, will begin to get noticed. And I think that's when people will interpret the bond sell-off or the rise in yields, which they assign to the economy's getting better argument. They'll realize that the bond sell-off is due to a commodity rise, coming inflation. They'll change their story, in other words.
All right. Well, we'll have to leave it go at that because we're out of time. Thank you very much, Michael, for being with us. Again, folks, it's OliverMSA.com, OliverMSA.com to track what Michael is doing. Thanks so much for being with us, Michael. We'll look to do it again.